that's what we would consider a massive income, right? A massive income is created by operating and just continually being involved in it in the day-to-day and making sure that that income or that revenue stream is generated. And then passive income, I actually refer to it often as mailbox money.
There you go. I love that.
Well, awesome. Welcome back, episode number 2. Jason, I'm excited to visit with you as always. Give us an opportunity to dive into real estate and investing. And, really today I think is about the generalities of why people would invest in real estate.
Yeah, I think it's going to be a great topic. And yeah, I'm glad to be back too. And I think that the thing that I really want to reiterate or get out there is so many people want to get in real estate, but they just don't know how. Or if you went out and talked to 10 people, 9 out of those 10 people would say, if you ask them, have you ever thought about investing in real estate? They would say, yeah, I've always thought about it. But there's something that's holding them back. And that fear, if you've heard the acronym, what fear is, false evidence appearing real, it really is. It's something they work up into their head that, only Trump or Oprah owns real estate. Who am I to own real estate, right? Yeah. I'm no Trump at all, and I'm no Oprah. But I do own real estate. And real estate is a phenomenal way to not only hedge against inflation, also hedge against, to plan for retirement, to plan for the down times and the up times, because you can make money in almost any economy. The economy is not bad or good; it's just different. And so, different real estate strategies are good in different economies. Like our economy has changed a lot just in the last little bit. Yeah, 2 years ago, you could do everything wrong in real estate and still make money. Now it's not so much. You got to be real strategic. You've really got to run the numbers 10 times instead of 3 times. I mean, you really got to make sure that whatever you're getting into, that you can buy it for a good enough discount to where you can fix it up, and then resell, or get it for a good enough discount that you can make it cash flow. I love this saying, when do you make your money? When you buy or when you sell? And it's when you buy. That's where you make your money. It's all about how you buy it. You get paid when you sell, but you make your money on how you buy it.
You bet.
And I think that's an important thing to remember, that it's really about the deal and about the numbers, which you talked about, in the last episode.
Yeah.
So anyways, I love this acronym. I want to break down with Colter.
Yeah.
And he's seen it before too, and it's ideal. Why real estate is an ideal investment. And I stands for income, D stands for deductions, E stands for equity, A stands for appreciation, and L stands for leverage. I got that right?
Yeah, you did.
I got that right. All right, so let's jump in. Let's just talk about the first one. Income.
Yeah. So, if I'm to dive into income, right, every business should be focused on how is it going to generate the buck, right? The almighty dollar that allows for them to actually create a business that can cash flow, that can pay for the expenses, and hopefully have what's called a net income, right? So revenue matters, expenses matter, and finally the net income matters.
Definitely.
Income to me in real estate is, I want anything and everything that I can possibly get in real estate to become passive income.
So tell me what the difference between passive income and regular income is.
Oh, yeah, absolutely. So from a tax perspective, there's operating incomes and then there's passive incomes, right? Operating incomes is, you go to a job, or you're selling, as a business, you're selling widgets, or you're providing a service. A marketing agency provides a service. They're an operating entity. And so that's what we would consider a massive income, right? A massive income is created by operating and just continually being involved in it in the day-to-day and making sure that that income or that revenue stream is generated.
And that could either be from business or just from a W-2 job that you're working at.
Yep, absolutely. And then passive income, I actually refer to it often as mailbox money.
There you go. I love that.
I love going, a lot of people dread going and getting the mail. I love seeing checks come in. And
I love it too.
All the bills are just an example or a correlation of the fact that all those bills represent some tie to a revenue stream. Whether it's, 14 different utility bills, that means there's 14 properties that are producing some sort of passive income that I can pay all those utility bills, not have to worry about them. And there's 14 checks in there that I get to go and deposit at the bank, and hopefully make a spread, right?
Yeah,
and that's the income we're looking for.
That's the dream, is to have that spread, right? The cash flow.
Absolutely.
I took my kids to New York last October because they want to go see the fall colors. My wife's from Buffalo, and so we decided to make a trip out of it. And we're sitting there looking over the edge of Niagara Falls. And it's the 3rd and the 4th. We were there in Niagara Falls. Well, we're standing there looking at the falls, and all it's my phone has this noise whenever I get paid on Venmo. It goes cha-ching. And we're standing there, and all it goes cha-ching, cha-ching, cha-ching. And my kids are like, what in the world's that? I'm like, that's people paying the rent. Because I collect rent through Venmo. And I'm there in Niagara Falls with my family making that mailbox money, or, phone money, I guess, whatever you want to call it. But that's passive. That's awesome. And my wife's like, man, that's such. She goes, I never really thought of it that way. But she goes, to have the kids are like, what in the world's going on with your phone? Why does it make so much noise? And I'm like, that people are making their most important payment of the month, and that's their rent payment to me. Well, number 2. Most people will pay their cell phone. They'll move the rent before they let their cell phone go.
Isn't that the truth?
I've helped quite a few people out when they're losing their house in foreclosure, and they never stop making the payment on their phone. They got to stay connected. But I love that passive income. That's awesome. And then the massive, taking that, if you're a doctor, attorney, CPA, working a business, W-2, out at the site, it doesn't matter. Wherever you're making some money, but you can take that money and stick it into mailbox money.
Yeah, absolutely. And the income, and I think we can dive into the next one. The income being that's what you're focused on. You make an investment, you have to create an ability to generate an income to pay for that property.
Yeah.
But now the government wants to chip in and give you some benefits, and those are some of the deductions that I absolutely love.
Love it, yeah.
And being a CPA and having collaborated and consulted with lots of other accountants and even attorneys, I think that a lot of people look at business owners of like, hey man, I gotta get in business so that I can buy the $80,000 pickup.
Yeah.
Man, and they're cool. Like, don't get me wrong, the $80,000 pickup is cool. But for me, the deductions were not the focus. I needed to figure out how to generate that income. The deductions of an $80,000 pickup wasn't it. I, looked at the first 10 years and I said, I'm going to live like nobody else right now, so that I can live like nobody else later. And for the first 10 years of investing in real estate, I didn't spend any of my passive income.
Just stockpiled it, or paid on your mortgage.
Or I paid on my mortgage, or I rolled it into the property next year.
Nice.
Because I knew that every year for 10 years, or every year for a foreseeable future, I was going to invest in the next property next year. And so if I'm dumping all that income into one bank account, and that's focused on buying the next asset that's going to generate a revenue stream, an income stream, then I'm going to build real wealth.
Definitely.
But if I would have bought a pickup, that pickup's not going to make me any money.
Nope.
I've got to go buy 4, 5, 10 more properties to pay for that pickup. And, that was my approach to it. And you know what? If somebody's ready to go and do 10 flips in a year, buy an $80,000 pickup.
There you go.
And pull all the trailers you want. Make sure that, that you're equipped to do that. And I think that's fantastic.
Yeah.
My approach was just to get to that point where I wasn't just spending all of the money for the deductions. So that's my caution, I guess. When we think about deductions is, heck yeah, business ownership is really valuable. You can take deductions. The government wants to chip in and not have to charge you so much in taxes, but there's a cost of you letting go of your cash to pay for depreciating assets. But depreciation is my favorite deduction.
Definitely.
Right? I buy a $100,000 property, and 90% of it is considered an improvement on 10% of the land or the land value compared to the total purchase price. Mm-hmm. I can take that 90% and over 27 and a half years on residential property, if I'm correct, and 39 years
on commercial.
Yep. I get to take that 90% of the value of that property, and I get a deduction every single year that counts against any revenue that I made on the property. And if I have in excess of depreciation on my property, it can actually roll in and deduct against some of my W-2 or other operating incomes. And that was cool for me.
Definitely.
That clicked to a point where it was like, okay, well, that's a non-cash expense that I get the benefit and not have to pay the tax on. I want more of that.
And if you can have a deduction to bring down your taxable income, that's basically creating more massive or sort of passive income. I mean, I always tell people, I'm like, if you can, penny saved, penny earned. I mean, that's, if you can save some money on taxes, that's money that comes into your home. That's extra money that you get to keep a hold of. It's like most people in America, they spend 30% of their income is spent on taxes, 30% spent on interest, and they spend 30%. I mean, Obviously, it's a little more 33, 33, 33. But that's how most Americans live.
Yeah.
33% goes to interest, 33% goes to tax, 33% at the end. That's what they spend. That's what they live on. Well, business owners, they spend, or pay 10% of their income in taxes, spend 10% on interest, and they get to spend 80%. What's awesome is you make all your money, take all your deductions, and whatever's left over, that's what you pay your taxes on. Where if you're a W-2, you pay your taxes first, then you spend whatever's left over. And here's what's interesting about real estate, is real estate's the only business that you can claim a loss every single year, and the IRS is totally fine with that. Any other business you have out there, you have to show profit 3 out of 5 years, or they'll come to you and say, hey, I don't know what's going on with your business, but you're not making any money. But real estate, you can have a negative every year for 20, 30 years, and it's totally fine with the government.
Yeah, and you see, I mean, people have heard those horror stories of the IRS showing up and they're doing an audit and now they're clawing back money because somebody had a hobby farm, or they had, they didn't do the home office deduction right, or they didn't do X and Y and Z right. And, as we talk about the IRS, we talk about taxes, like that's what we've seen. Like, and in real estate, we've seen how real estate is protected generally in the United States, and the buyers of real estate, the landlords, and there's different laws for every state.
Definitely, and we're not attorneys, or I guess you are a CPA.
Yeah, I'm a CPA, but you're not taking my advice, right? Like, you get what you pay for. This is a free podcast,
this
right?
This is just general information. That's right.
So, I mean, as you take our advice, whether it's accounting or legal related, right? We're not qualified to be able to provide that.
Get a hold of your own CPA, your own lawyer. Make sure that what you're doing is best for you.
Yeah, and so as you look at all of these things, you want to have people on your team that can give you advice. Like, we're talking about our experience in having done real estate. That's where we're coming from. Accountants, attorneys, those guys are the experts in focusing on helping make sure that you're protected and that you're paying your fair share.
Definitely.
And you shouldn't pay any less than your fair share of taxes.
Yep. I had somebody come to me and said, well, if all the government finds out that there's all these loopholes in the IRS for people that are real estate investors and farmers and ranchers that can have all these deductions, aren't they going to stop doing that? And I'm like, do you know what? Probably 90% of all legislators out there, do you know what they own? They own real estate, farms, ranches. They want the deductions just as much as I do.
Yes, they do.
They do, and so it's not going away. It's not going away. I mean, it may change depending on who's in power, but for the most part, it's going to be the same. You're going to get those deductions.
Yeah.
So I love that. So the next one, so in our acronym IDEAL, there's income, deductions. The next one is equity.
Yeah.
So everybody's seen a little bit of equity in this last little while. Over the last 3-4 years, what's happened?
Oh, we've seen a massive increase, right? We saw inflation, but we also saw appreciation tied to that.
Yes. So equity is the difference between what you own your property and what it's worth. That spread in the middle is your equity. And if you're not taking advantage of that equity is not doing you any good. You can brag at with your friends, oh, I've got, $400,000 equity or $300,000 equity. That's great. But what could you do with that equity? That's the part where I want to jump in and help people out. If you could take that equity, get a home equity line of credit, or leverage it somehow, there's so much you could do in real estate and business by leveraging that, so that you take your equity that's just sitting there and go out and have that help you make more money, to bring more money in, to either pay down more bills or to create massive and either passive wealth. Yeah, I think the equity part is huge.
Yeah.
And then the next one, or you want to do a little more on equity?
I wanted to ask about your last year, because you cashed in on some equity last year.
We did, and I had to pay some taxes over it too. Yeah, I bought this little 3-bedroom, or it's a 3-plex. I picked it up for $80,000 about 4 years ago, and ended up selling it for $270,000.
Wow.
Yeah, I mean, I had to pay some expenses. I refinanced it in there, but just a small little refinance, because the interest rate I got was horrible. So 3 months later, I refinanced it. So it cost me a little bit for the refinance, but the IRS didn't, because it was an income producing property, I had to qualify, or I had to claim it differently than just my normal business. So I had to pay a little taxes. But because of what I know about taxes, man, I could have paid a whole bunch more. Even though I wrote that check and it hurt a little, for the amount of money that we made off of it was pretty dang awesome.
Yeah. Well, that's awesome. So in that 4-year time frame, that equity was created from appreciation.
Yep.
Right?
Yep. And that's the next one, appreciation. Yeah. I mean, appreciation's been crazy this last little while. And over the average of the last 40 years, they've been keeping track of appreciation. They've been tracking it. The average across America is 3.7%. And that may not get you too excited, but when you find out what the next one is, which is leverage, that's what makes me excited about the appreciation part and about the equity. So let's jump into that just a little bit on how appreciation and leverage, we can work that together.
Yeah, let's do that. So if I'm looking at appreciation against leverage, I analyze property the same way almost every time. So, and I focus on cash flowing, income producing assets. I had somebody ask me today, hey, what do you think about developing residential lots? I'm like, yeah, I think it's great. It's a strategy I've not ever really delved into. I've been focused on residential, commercial, industrial, manufacturing, cash flowing, income producing properties.
Yeah.
That's what I've done. That's where I've been focused. But on the appreciation versus the leverage is, if I put 10% down on a property, so let's call it a $1 million commercial building.
Okay.
I take $100,000, and it doesn't have to be all my own money, but let's just pretend it is. So $100,000, and I'm going to produce, let's say, $10,000 a month in rent out of that property.
Okay.
Right? $120,000 a year, and my expenses are principal, interest, taxes, and insurance. Right?
Yeah.
So let's call those $5,000 a month or $60,000 a year.
Okay.
That's $60,000 a year in net income that I'm producing.
Because it's generating that much, double that per year.
It is.
Yeah.
Yeah. So that's $60,000. If that's my net against my $100,000 cash investment down payment on that $1 million property, that's a 60% return on my $100,000 invested.
Which is pretty dang awesome.
Pretty dang awesome.
And then you take that to another level of that business or that building that you bought appreciates the 3.7%. Now you just got another return on your investment that has nothing even to do with the income producing property.
It does.
Right?
Yeah.
I mean, and what's great about that is 3.7% on 100,000 probably doesn't get anybody too excited. But is that appreciation on your 100,000 or is it on the $1 million building?
It's on the $1 million building. So that's another $37,000 in appreciation
Exactly.
because of that asset that I was able to tie up, leverage, and pay interest on, right?
Yeah.
Which I get a deduction over here. But it also increases my cash on cash return, which my cash is the hardest for me to get a hold of. It's going to be the hardest for me to let go of.
Definitely.
And I want it to be able to return as much as I possibly can on that cash. And if I can use somebody else's money, the banks typically, or other very creative or other creative solutions, that allows for me to leverage my cash to be able to buy more property.
You hit the nail right there. That's the part I'm excited about. Is you can use your own money, but you don't have to use your own money. So if you borrow somebody else's money for that down payment, what's your return on investment then?
Well, I mean, if you have no delta, I mean, the sky's the limit, right?
Exactly. That's what's so exciting. That's why I love real estate so much. The leverage part of it, I think, is the part where most people don't understand how powerful leverage is on real estate. Let's say that somebody gave you a hot stock tip on Nike shoes and said they're going to double in value. And you went to the bank and said, "Hey, I just got this hot stock tip that Nike shoes going to double in value. I need $10,000 or I need $100,000 to invest in this stock." What would they say?
They think we're crazy. Right?
Exactly. Exactly. But they'll do it all day long on real estate.
Yeah.
All day long. You can talk to friends, you can talk to neighbors. There's probably people right now in your circle of influence, whoever you hang out with, or your family or aunts and uncles, that probably are sitting on a bunch of cash that would love to put that somewhere safe, have that somewhere where they know it's an asset, that they can tie that to something, that would love to fund a deal.
No, absolutely. And one of my favorite questions, and I think that everyone should use this if they're ever interested in investing in real estate, is, hey, do you know anybody that would be interested in making 6, 7, 8% return on their investment every single year, backed by real estate?
Who's going to say no to that?
Right. And so they're starting to think about not just a friend or a brother or sister, a mom or dad, or somebody that they ran into at the grocery store. They're going to think about, well, I want 6, 7, 8% return on my investment, and I want it to be protected by an asset that I can trust,
Yeah.
right? And real estate is one of those things that you can trust.
Definitely.
Over time, right?
Over time.
And when I come back to appreciation, right? When I run my calculations, I'm not counting on appreciation, even though I know and expect it's coming, right? Mm-hmm. Appreciation is speculative from my standpoint,
Okay.
right? But I love it
because
it shows up anyways, whether I do anything for it or not.
Yep.
And so I think again, there's so much value in real estate, and there's so much value in just being able to connect the dots. People want assets that produce a passive income, and real estate is one of those highest on the list that I've ever found classes of asset that can actually produce that.
And you don't have to be a certified public accountant to do it.
No.
I mean,
No,
it's
you don't.
awesome that you are. But what I'm saying is that you're just normal. I was a truck driver for 15 years, and I'm a full-time investor. And it only took me a few years to jump into real estate where I could do it full-time. And all the different stuff you've done, and now you're doing full-time, buying businesses, improving businesses, selling businesses. You buy in real estate. That's the thing. People got to realize you don't have to be a brain surgeon. You don't have to be a rocket scientist. If you are a rocket scientist, you can still do real estate, but you don't have to be. You don't have to be. And that's why I love that acronym of IDEAL. Real estate's an ideal investment. I for income, D for deductions, E for equity, A for appreciation, and L for leverage. So I think we're out of time.
Yeah,
But man, I'm so excited about what we talked about. I think this resonate with a lot of people. And tune in next time. We're going to go break down one of the strategies. There's so many. Let's just think about all the different strategies we've got, just so you can think of to buy and sell real estate.
Yeah.
I mean, there's
subject to lease options, wraparounds.
Yeah, wrap mortgages. Yeah.
Double wraparounds.
Yes.
Seller carry notes.
Seller carry notes, and then we've got just regular fix and flips, rehabs, short-term rentals, which is your Airbnbs or VRBOs. There's so much to real estate. I learn stuff all the time. I mean, VRBO and Airbnb wasn't even a thing 10 years ago.
No, it wasn't.
Wasn't, and now it's a huge thing to go out there and invest. And then you can jump into retirement homes and assisted living homes. That's another big real estate thing. We could spend a week just talking about that.
Oh, man.
So there's so much different ways to make money in business and real estate, and they coincide so well together.
So we'll start to dive into the details, whether it's subject twos or wraparounds or any of that long list that's far from complete. We're going to start diving into how to do those, how we've done them in the past, and likely invite some other folks that have done them as well.
Definitely.
In the future, and make sure that we have some real solid numbers and figures that have helped complement getting deals done and doing them right and making that massive passive income.
Let's do it. Thanks for tuning in.
Yeah.
We'll see you on the next one.
All right.